Finterra, or Grupo Finterra, is a non-bank financial institution. We call them, or we know them as a non-bank bank. We cannot receive deposits from the public. And I will go through and let you know who is our funders. Well, this is the objectives of this presentation. And first of all, I want to apologize. My English is not too good. I don't use English at all. I use mostly Spanish and very regional Spanish, so I apologize from the very beginning. Well, Finterra is, the formal name is a SOFOM that was created in June 2003. I was working for the government, shutting down the Ban Rural and starting with the Financiera Rural when I started this project. This was the second non-bank bank or non-bank financial institution dedicated to the agribusiness in Mexico. And we start our operations in September 2004. The name SOFOM, this is in Spanish, means Financial Society for Multiple Purposes. And this is, well, our purpose is agriculture. Every institution should decide where to work and what kind of product should deliver to the market. And we decided to stay in agriculture and mainly financing. We don't lease, we don't make factoring, we just give credit in different choices or possibilities. We only operate in Mexico. And the source of our funding is FIRAS. FIRAS is the central bank's trust for agriculture, and that trust funds banks, commercial banks, and non-banks institutions. We have some funding from the IFC. The DIG is a German investment and development company. We have also money from the Multilateral Investment Fund of the Inter-American Development Bank, and also Rabobank that holds part of the share of Finterra too. We started operations, as I told you, in 2004 with 4 branches and 4 relationship managers or lending officers. And up to 2013, we have 18 offices and with 39 relationship managers. This may not look too big, but we are struggling with a very competitive market in Mexico. Our portfolio has grown from nothing to almost $110 million as outstanding. This is in almost 9 years. For you to find where is Mexico, maybe some of you are not aware, we are just south of the United States. We share a 3,000 kilometers border with the US. We're very close to the biggest market in the world for fresh produce. And for us, that's an advantage. We can get in the border in probably some places around 3 hours drive. And then you have all the market right beside the border. And we ship also to Europe and some other parts of the world. Mexico is one of the countries that has the largest number of free trade agreements in the world. We have a huge one with Canada and the United States. We have some big ones with South America, Central America, and the Pacific Ridge, Japan, and all this Southeast Asia. And that for us is an advantage, but for us it's also a matter of competitiveness. We cannot many times compete with some produce that are, I don't mean agricultural, industrial items, that are cheaper produced in some other parts of the world. And if you can import those goods in Mexico cheaper than what we can produce, well, the market shifts to foreign produces. And sometimes that happens, for example, with milk, with some fruits as apples or sometimes grapes. But that's a matter of competitiveness. How do we look for investment opportunities? Mexico is a large country. We have two growing cycles, as we learned this morning, that Turkey has also two main growing cycles. We call them spring, that is, we've grown our products in the central and south part of Mexico from the months of April to December, and the winter that goes from September to May, more or less. We have large coastal irrigated areas. This is below 900 meters above sea level, and this gives us the opportunity to grow corn, vegetables, tropical fruits, and breed cattle. And we have large water management associations for irrigation purposes mostly. And then we have uplands that allow us to grow some coffee, corn, dairy, avocado, high quality fruits and vegetables. Most of them are exported to the US. We had a large food industry. We have packers, processors, value-added industries. We have important chain of warehouses. We are used to give credit on warehouses receipts. Along the country, we finance distributors of agri-input products, suppliers, agri-crop traders, grain elevators. We also finance farm machinery, irrigation systems, and technology providers or sellers. How do we identify our market? I'm presenting these numbers. We have above 4 million very small size growers or farmers. We have not that many small farmers, less medium farmers. This is the pyramid we were looking this morning. This is the same happens in Mexico as should happen in any country in this world. And if you see, we made a study and we determined the financing needs for all these different segments. And for the micro farmers, for us, it's very difficult to get to them directly. We have to go through some change, some relationship with industries or with marketers or whatever help us to reach the smallest ones. We have some sugarcane growers that are very small, probably 1 to 3 hectares. And we have our focus in medium and large farmers, mostly medium farmers. And we work through individual loans with them. Large farmers are corporate companies mostly, and those are for the commercial banks. The financial market structure in Mexico, it's very, let's say, fulfills all the range of possibilities. We have probably around 20 large commercial banks. Many of them are international banks. We have medium-sized commercial banks, probably 8 to 10, no more than that. And there are over 500 non-bank financial institutions like us. And within those 500, there are about 11 to 12 where Finterra belongs, that they are the biggest ones, the most serious, and we have to compete with the banks. So that has pushed us to make a strong effort to get a good wallet portfolio, to have a good selection of our clients, and that's a task, and that's what I'm going to talk to you about this. To keep on these investment opportunities, in agriculture, we have focus in grains, fruits and vegetables, and sugar cane. Livestock is animal protein and dairy. You may see a large universe of farmers, but actually we focus on probably no more than 100,000 farmers. That's our main approach. And probably up to 500,000 in the small size that are linked to some kind of industry. So we make this analysis and then we start cutting what's our segment or our objective segment. Now, to land these ideas in this risk assessment, first of all, and before we start doing any kind of analysis, we set our policies as any other financial institution. We set our policies and we try to solve part of the problem of client acquisition before we go to the market. For example, to us, I'm going to show you our model. The moral solvency is basic. You may be aware that in Mexico, some years ago, banks must deliver some credit to the agricultural sector. It was up to 6% of their wallet. But unfortunately, this portfolio was loaded with immoral growers. No, they went to the banks to pick money. They did not need it, but the banks were forced to give this money to the agriculture. So it was like somebody's delivering or giving away money, so just line up and get your money and go away and never pay back. That happens before 1990, and from now on, we've been trying to clean all this mess up. It's not too far away when this happened. So there's still some bad practices in the clients or in the producers, and we have to be very aware of who are we incorporating as a client. Well, we look at the economic soundness. Our clients should participate in agriculture-related business or are, in some cases, in rural areas. They have to use adequate technology. We don't used to talk about good, bad, recent, ancient, or whatever technology. We have to look at the level of technology that should be appropriate for the conditions of our client. We have some greenhouse growers. They have all the greenhouse automatized, so they actually do nothing but cropping and harvesting. Those greenhouses are like robots. And we have some growers that used to work manually as coffee growers, for example, coffee people in the Indian areas that used to do everything by hand. And we don't care if they use their hands or they use high level of technology. We want them to use the proper technology. We ask them to have at least 3 years of experience in his main source of income. And if it is going to be rural financing, we ask them to have at least 5 years of experience. In agriculture, we ask them to be in irrigated areas or in recognized good rain-fed areas. Their market should be identified. We should know what's the destiny of the products. And also, we have to know who is the buyer of the products. We ask them to provide us with financial statements. Sometimes they're very tough to get clear ones, but we work with our clients to prepare them. And also, we don't care the size. We care about the market. We care about the experience and the projections of the income. Our credit is based on cash flow analysis. For example, we are not financing fisheries, but it's out of our target market. But we are thinking in beginning with this industry. So we took the Porter's model, and we look at the threat of new entrants, the threat of substitute products or services, the bargain power of customers, the bargain power of suppliers, and the intensity of the rivalry. This is for us to decide entering into a new segment or into a new industry. We are open to agriculture, but for example, we don't go in animal protein. We're not financing poultry now. We will start probably late this year, but we have to make an analysis of this kind. We'll look at the weather of the region where our client is working and what are the crops related to the weather. We don't accept that the grower that is producing soybeans may want to switch to grow mangoes, for example. No? We have to be sure that he knows what he's doing. We look at the existing infrastructure. We look at the degree of integration or the existence of the value chain, and we look at social and environmental restrictions. If there is some social issues, we don't go with that client. For example, labor of youngsters or children work. So we do not accept those kind of clients. So we have our general credit policies that make us go in the selection of our clients. We don't distinguish the risk assessment for agribusiness as corporations or individuals participating in them. We want to create long-lasting relationships, so this is why we take care of analyzing very deeply our client and our client's profile. We don't go slide. We want to keep all these clients forever with us. And if the competence is very hard with banks, with commercial banks, so we want to be sure that these clients will last in our relationship. The documentation we request depends on the type of organization, the land tenure, and the collaterals we will formalize. I'm sure that our credit process is not different than the credit process of your institutions or the commercial banks. We begin with this client profile definition. Then we receive all the documentation. We receive the financial statements to be analyzed. We make the credit analysis. We analyze the technical aspects, production and productivity, their markets, marketing, management policies of the client. Then we go through the process of the approval, and then we have a second check in the legal review of all the documents before we contract any credit. Legally, they have to be very sound, all the contracts, and we have an operations area that controls that all the approvals are well contracted and well operated, and those guys are tough. They don't let us move unless everything is very well set. And now I'm going into the risk assessment. We call this an expert risk assessment, and this helps us to have a clear idea of the client's character, a clear idea of whatever that means. We don't have a thermometer to measure the morality, but we're doing our best trying to figure out how to measure these aspects, and I'm going to show you the tool we use. We have to know the capacities of the client, not the potential. Our analysis goes backward. We want to be sure that what the client is saying is true. We don't believe in his projections. If a client wants to grow, he can count on us. He can rely on us. But for the analysis purposes, the client is analyzed looking at the past. We don't believe that they always promise us to grow. They will gonna grow 100% this next crop season. They're gonna grow 50%. Would say, no, you've been able to grow probably 20% a year or something like that, and that's our limit. We won't go farther than that. Agriculture, well, for me, it's a hope. It's a matter of hope sometimes that the weather will come good, that there will be no market problems, and we don't want to rely on those expectations. We rely on what the client has been able to achieve. To identify the capital, the equity our client has to invest, because we want to go together. We don't. This morning we were talking about lending more than what the client needs actually. So we want to go together. We want him to invest his own capital, and we want to go with him in this investment ideas. We request a sound collateral and propose a condition to formalize the credit after we finish with the analysis. We hire experienced lending officers. These people is experienced in agricultural financing. They should have banking experience and understanding of agricultural activities and have an agricultural biological university background. And we hire them locally. Well, let me go a little bit further. I'm going to show you what we call the pre-grading or pre-risk grading. This is for the credit application. We check the backgrounds of our client. May I have the first one? No, the previous page, please. Just the first link. That one. This is a translation. I will show you the operating model. With, for example, we call it a pre-qualification of the applicant. We have his name, we have the ID number, and then we go into the legal status of the applicant. Is the applicant married? This is just to show you, because I'm going to show you the actual tool in Spanish. I'm sorry, it's in Spanish, but it was difficult to translate in the English and then make it work, because the risk people didn't want me to release all our knowledge. No? So like, so may I have the second one? Okay. Can I handle from here? Well, I'm going to show you how this works. For example, the first lane is what's the legal personality of the applicant. And the one you can see here, it's just a single person. And I can go to a company. And if you look, things change. For a single person, for example, the next question is he married under a legal agreement? If I say no, nothing happened. If I say yes, it requests me the name of the spouse. No? If this is a company, let's say, we call it moral person, they ask me how many people is involved in the administration. If I can write here, let's say 3, you can find here the places for the name. If I have probably 5, I may have this. It opens so I can record more. This one is asking me if there is some major stockholder. If I say yes, immediately the model asks me who's that man. Also, there is this space is how many related companies are to this particular company. If I say that 1, nothing changes. 2, it asks me to write the names of the companies. No? And what's this for? In this combos, we have to check the credit records of the individual, the company, and the related companies. We go to the credit bureau that we have, and we have, for example, in this case, is high risk. Well, let me start with the good risk qualifications in this one. I'm gonna move this a little bit to go faster. Excuse me. And this combo asked me if there are more than 1 stockholder that may have over 15% of the company. If there's more than 1, I have to write his name here and go through his qualifications also. Okay, so I'm going with a non-named man, but let's say this is also good risk, and this one, let's say it's regular risk. And then I have that the main stockholder is a good risk, well, good level of risk, and the second one is good, and the third is regular. This part is because of FIRA, this trust provided with some backgrounds also of the clients, only if they are, let's say, bad risk. If they are regular, fair, or good risk, FIRA don't tell us anything. So, for example, in this case, I'm going to pick the good background. This is the date of the report. And then we go and ask some of the references. Could be suppliers, could be clients. And then we write the name of the, if I write here just 2, this one will not be taken by the model. If I write 3, it's going to be taken this one. And they say, for example, with this one, they have an excellent relationship with this supplier. I can leave it there. This is another supplier, and this is another supplier. The 3 of them gave us good references of this client. And then we have these qualitative qualifications, the experience on the sector, where does this client particularly get the water. For example, this is well, could be from a river, could be rain-fed, could be from a spring. But let's say this is water from a dam. The land tenure, if these are the Mexican possibilities. Ejidal, that belongs to the government. Comunal, that belongs to a sort of cooperative, leased or owned. How easy is to access the production unit? Is this permanent, or this may be seasonal? So you pick permanent. And then we have the state of the country. This is because the laws are different in the different states of the country. And if you see, there is a point here that it's 9. To us, 7.5 or below that is a risk that will not be accepted. Let me see how this changes. For example, if I move this to regular, this dropped to 8.3. This is still acceptable. Excuse me? I don't know if that would be a high risk or not, but well, what happened is that I have to change this. So she may ask me for their marriage status. He's not married. And see how it changes. Barely passed. But if he's married, the model will ask me for her, in this case, his wife. I can say that's a high risk. And didn't pass. Well, this is the pre-qualifications. I'm going to show you now the model with which we make our provisions. May I have the other one? Mm-hmm. That's the one. Commercial banks must create provisions based on a risks model. We adopt that even though we are not a commercial bank, because it has helped us a lot in generating all the provisions we need as a financial institution. We are not supposed to do that as a non-bank institution, but we prefer to take this, let's say, this advantage of measuring ourselves. We are trying to become a commercial bank, so when the authorities come, we'll show them that we are fulfilling already their requirements. The previous model brings us to this first case, and then we have these other qualifications here. I will go through the operating model also. And we'll look at the technology level, the applicant assets that will be insured, the ownership of the land, the formality level to secure sales and markets. This is now objective, and the state of the country where the activity takes place. In this case, we want to measure the administration capabilities of the company. Then we have some financial measurements here. For example, what's the trend of the growth sales, the liquidity as a ratio, the immediate liquidity, the leverage ratio. This is total assets divided by the total liabilities. The ability to pay. This is all the payments they have due. That's dividing the EBITDA. The debt horizon, the profitability of the operation, the return on equity, and the quality of financial statements, the years in the activity, the installed capacity divided by the production capacity of the facilities. This model is also some sort of an expert model. Then we request the applicant's productivity versus the sector's productivity, the applicant's unit cost against the sector's unit of cost, and the volatility of the price of goods or services. This, as we were talking this morning, we are already compiling all this information into one model. This is not a credit score model. This is applied in case by case, and when we have the financial statements of the client. Well, just let me go quick through the other one. I'm sorry, I know I'm within my hour, but okay. This first is a pre-qualification we got from the other model. What is the opinion of the character of the applicant? This is just an opinion that the relationship manager or the lending officer must have on his client. For example, in this, how many commercial references were positive? How many of the references had negative result? How is the administration of the business? Is that a professional? Is that a familiar? Or is only one man decision maker? How's the experience as a Finterra client? It could be excellent, good, regular, bad. And also, what's the legal figure of the client? This is the technological level for the activity. That's adequate, that's enough, or deficient. What are the main assets that are insured? For example, if he's a corn grower, he's insuring only the infrastructure, for example, or he has nothing insured. What's the property or the tenure of the property? It's owned, it's ejidal, it's a cooperative, or it's leased. How is the security level to sell? Okay, he may have some contracts or he may have nothing. He's going to the streets to sell what he's producing, or he has some contracts. And also, where is the state of the country where our client is set? In this case, we have a qualitative qualifications. If I said, for example, this is bad, we don't have non-secure or insured. This may change. Well, I'm not changing very much. For example, we don't rely very much on the character of the client, and the qualification drop. The best qualification is 1, the worst is 10. This is excellent, this changes. or in the pre-qualification is bad, this one changes. And then we go to the financials. We can just play a little bit with this. And this brings us the risk qualification, the final risk qualification of this particular client. And with this qualification, we make the provisions for his credits in the next future. Okay. Okay, just to conclude, there is no tool that can change the character of the client. There is no tool that can improve his capacities. There is no tool that will take us to increase or provide the capital needed for the operation. This is our approach to the client. There is no tool that can ensure that a collateral will force a client to prepay the loan. And no tool will define as the condition to perfect the credit. To us, there is nothing better than knowing what we're doing. There's nothing better than knowing the growing or production conditions of the client and understanding what can be grown or risen. There's no better than keeping a close look at the use of the credit. And I was thinking this morning, when we were traveling to Colombo, we stopped by London. And we had a chance, my wife and I had a chance to visit the British Museum. And after walking around all the museum, we realized that humanity has been the same for about 8,000 years. Nothing has changed. There's nothing new under the sun. And that's what's happening this morning. I was listening to all the people that had presented their banks and their institutions, and say, well, it's very, for me, it's been very enrichment, looking and listening and seeing all the experience that you have brought to this conference. And I said, well, there's nothing under the sun, but we have to have knowledge. And the way we apply knowledge is the difference. And to us in Finterra, the knowledge has been the difference from some other competitors. And I think that's why our portfolio has been grown solid. We are not exploring, we are trying to use our knowledge. And that's at least my conclusion for this morning. It doesn't matter how much you know, how much you have learned. It depends on how you use the knowledge. And that's why we will not move from this. We have to know personally each one of our clients. Even though they are very small or they are very large, we want to to provide them with the service they deserve, they need, to be there with them on time. Well, that's it. Thank you very much.